Warren Buffett, the Oracle of Omaha, is one of the most successful investors of all time. Known for his folksy wisdom and incredible financial acumen, Buffett has become a household name not just in the world of finance but globally. His journey to becoming a billionaire is a fascinating tale of perseverance, intelligence, and a keen understanding of the market. Buffett's story began in Omaha, Nebraska, where he displayed an early knack for numbers and business. He started investing as a teenager and over decades built a massive fortune. His first foray into the stock market was at the age of 11, and by the time he was 13 he was running his own businesses, including a paper route and selling magazines. He was a voracious reader, devouring books on investing and finance. This early education laid the foundation for his future success. Buffett attended the University of Nebraska and later went to Columbia Business School, where he was taught by Benjamin Graham, the father of value investing. Graham's principles had a profound impact on Buffett's investment strategy. His company, Berkshire Hathaway, is known for its diverse holdings and incredible returns. Originally a struggling textile company, Buffett transformed it into a conglomerate with interests in a wide range of industries, from insurance and utilities to railroads and consumer goods. The annual Berkshire Hathaway shareholders meeting, often called the Woodstock for capitalists, attracts thousands of investors from around the world. Buffett's success isn't magic, it comes from a disciplined approach to investing that anyone can learn. He is known for his patience, often holding on to investments for decades. His philosophy is to buy quality companies at a fair price and hold them for the long term. This approach minimizes risk and maximizes returns over time. Buffett's investment philosophy is surprisingly straightforward. He focuses on companies with strong fundamentals, such as consistent earnings, good management, and a competitive advantage in their industry. He avoids complex financial instruments and sticks to what he understands, a principle he calls staying within his circle of competence. He focuses on identifying undervalued companies with strong fundamentals. This means looking for businesses that are trading for less than their intrinsic value. Buffett's ability to spot these opportunities has been key to his success. He spends hours reading annual reports and financial statements to understand the true value of a company. He then invests for the long term, letting his investments compound over time. Compounding is a powerful concept that Buffett often emphasizes. By reinvesting earnings and allowing them to grow, he has been able to amass a fortune that continues to grow exponentially. This long-term perspective is a cornerstone of his investment strategy. This approach has made him billions and serves as a blueprint for aspiring investors worldwide. Buffett's legacy is not just his wealth, but the wisdom he has shared with others. His annual letters to shareholders are widely read and offer valuable insights into his investment philosophy. For anyone looking to build wealth, Warren Buffett's life and career offer a masterclass in the art of investing. At the heart of Buffett's strategy is value investing. This approach is not just about picking stocks, it's about understanding the true worth of a business. Buffett's philosophy revolves around the idea that the stock market often misprices companies, either due to short-term issues or market sentiment. By focusing on the intrinsic value, he aims to capitalize on these discrepancies. This principle is simple to understand but requires patience and discipline to execute. It's not about quick gains or following market trends. Instead, it's about thorough research, understanding the business model, and waiting for the right opportunity. Buffett often emphasizes the importance of a margin of safety, which means buying stocks at a price significantly below their intrinsic value to minimize risk. Imagine you can buy $1 for only 50 cents. This metaphor illustrates the essence of value investing. It's about finding those rare opportunities where the market has undervalued a company's true worth. Such opportunities are not always easy to find and require a keen eye and thorough analysis. That's a great deal, right? But it's not just about the price. It's about understanding why the market has mispriced the stock and whether the company's fundamentals support a higher valuation. This involves looking at financial statements, understanding the industry, and assessing the company's competitive advantage. Value investing is about finding companies whose intrinsic value is much higher than their current market price. These companies often have strong fundamentals, such as consistent earnings, good management, and a competitive edge in their industry. However, they might be temporarily out of favor with the market due to short-term issues. These undervalued companies might be overlooked by the market for various reasons, such as temporary bad news or being in an out-of-favor industry. For instance, a company might have missed earnings expectations for a quarter, or there might be broader economic concerns affecting the industry. However, these issues are often temporary and do not reflect the company's long-term potential. Buffett looks beyond the noise and focuses on the underlying business. He examines the company's fundamentals, such as its revenue, profit margins, and growth potential. He also considers qualitative factors, like the strength of the management team and the company's competitive position in the market. If he believes the business is fundamentally sound and has long-term potential, he invests, even if the market undervalues it at the moment. This long-term perspective allows him to ride out market volatility and benefit from the company's growth over time. In essence, value investing is about being patient, disciplined, and having a deep understanding of the businesses you invest in. Buffett is a firm believer in long-term investing. He doesn't try to time the market or make quick profits from short-term trades. Instead, he invests in companies he believes will perform well over many years, even decades. This approach allows him to benefit from the power of compounding. Compounding is like earning interest on your interest. Over time, even small amounts of money can grow exponentially through the magic of compounding. This is why patience is a crucial virtue for value investors. Buffett stresses the importance of thoroughly understanding a business before investing in it. He reads annual reports, studies industry trends, and analyzes a company's competitive advantages. He wants to know how a company makes money, its growth prospects, and the risks it faces. This diligence helps him make informed investment decisions. He doesn't rely on rumors, tips, or market hype. Instead, he bases his decisions on a deep understanding of the businesses he invests in. This approach minimizes risk and increases the likelihood of long-term success. Section 5, A Tale of Two Companies, illustrating Buffett's principles. So let's say you're considering investing in two companies, Company A and Company B. Company A is a trendy tech startup with a soaring stock price but no profits. On the other hand, Company B is a well-established consumer goods company with a history of steady earnings and a reasonable valuation. Now, a growth investor might be drawn to Company A, enticed by the promise of high returns. However, Buffett would likely favor Company B. Its consistent earnings, strong brand, and reasonable price align with his value investing principles. Section 6. Patience is a virtue navigating market volatility. The stock market is inherently volatile. Prices can fluctuate wildly in the short term, driven by news, emotions, and speculation. Buffett understands this and doesn't let short-term market swings dictate his investment decisions. He knows that the market often overreacts to both good and bad news. During market downturns, he sees opportunities to buy great companies at discounted prices. He remains focused on his long-term investment horizon and doesn't panic sell when the market gets choppy. Section 7. The Circle of Competence, investing in what you know. Buffett emphasizes the importance of staying within your circle of competence. This means investing in industries and businesses you understand. You don't need to be an expert in everything, but you should have a good grasp of the fundamentals of the companies you invest in. For example, if you're familiar with the retail industry, you might be comfortable investing in retail stocks. However, if you don't understand the complexities of biotechnology, it's probably best to avoid investing in biotech companies no matter how promising they seem. Section 8. Learning from the best Warren Buffett's enduring wisdom. Warren Buffett's investment philosophy offers valuable lessons for investors of all levels. His approach is not about getting rich quickly, but about building wealth gradually through disciplined investing and a long-term perspective. His emphasis on value investing, understanding businesses, and remaining patient during market fluctuations provides a roadmap for achieving financial success in the stock market. By studying his methods and applying the principles he espouses, investors can improve their chances of achieving their financial goals. Section 9. Key takeaways, your journey to investment success. Here are some key takeaways for beginner investors inspired by Warren Buffett. Investing can seem daunting at first, but with the right approach, anyone can become successful. Warren Buffett, one of the most renowned investors of all time, has shared many valuable lessons that can guide you on your journey. First, invest in what you understand. This means putting your money into businesses and industries that you are familiar with. When you understand how a company makes money, you are better equipped to evaluate its potential for growth and profitability. Focus on companies and industries you know well. Second, look for value. This involves identifying companies that are trading for less than their intrinsic value. By buying undervalued stocks, you increase your chances of making a profit when the market corrects itself. Seek out companies trading below their intrinsic worth. Third, be patient. Investing is not a get-rich-quick scheme. It requires time and patience. The most successful investors are those who hold their investments for the long term, allowing their money to grow through the power of compounding. Hold your investments for the long term to benefit from compounding. Fourth, ignore the noise. The stock market is full of short-term fluctuations and distractions. It's important to stay focused on your long-term goals and not be swayed by daily market movements or sensational news stories. Don't let short-term market fluctuations sway your decisions. And fifth, keep learning. The world of investing is constantly evolving, and there is always something new to learn. By continuously educating yourself, you can stay ahead of the curve and make informed investment decisions. Continuously educate yourself about investing and the businesses you're interested in. This could involve reading books, attending seminars, or taking online courses. The more knowledge you have, the better equipped you will be to navigate the complexities of the stock market. By following these principles, you can start your investment journey on the right foot and increase your chances of building lasting wealth, just like the Oracle of Omaha. Remember, investing is a marathon, not a sprint. Stay disciplined, stay informed, and stay patient, and you will be well on your way to investment success.